The screen is showing you a sea of red, but the numbers don't tell the truth. They tell a story designed to make you blink. It's early afternoon, January 8th, 2026. While most people were finishing lunch, silver just got hit with a sledgehammer. And right now, two major US brokers are burning up the phone lines, telling institutional giants that a meltdown is coming next week. They're pointing at the Bloomberg Commodity Index rebalancing as the smoking gun. They want you to believe $6 billion of silver is about to hit the market. I'm going to show you why that math is a lie designed to hunt your liquidity. Because if this isn't a fundamental sell-off, it's a setup, and the trap is about to spring. I'm a private commodities analyst. I've been stacking physical silver and trading this market for 12 years. And I built this channel because I was tired of waiting half a day for mainstream news to report what I was already seeing in real time on my terminal. The AI avatar, that's just the fastest way to get this intel to you while it still matters. Here's my primary claim. This isn't a market correction. This is a synthetic liquidity hunt. Brokers are allegedly inflating the impact of a routine index rebalance to trigger a panic, allowing them to collect short-side profits. The mechanism they're exploiting? Index rebalancing arbitrage. In this video, I'm going to expose the broker short campaign, run the actual math that the media won't touch, and reveal my personal if-then battle plan for the next 72 hours. I need to be clear, I am not a financial advisor. I am a guy with a calculator, a Bloomberg terminal, and a screen. I will tell you exactly what I am doing with my own capital, but the risks are mine alone. You need to make your own decisions. But before we look at the math, we have to look at the carnage on the tape. I was looking at my screen a few hours ago, and here's what I saw. Silver at $75.84, down 3.71%. That's a staggering move. Gold? $4,447.47, down only 0.35%. Let that sink in. Silver is outperforming gold to the downside by a factor of 10. This is not a precious metals move. This is a targeted silver strike. When I pulled up the chart, what I saw was a panic dump, a vertical drop through support levels. No consolidation, no bounce, just a straight flush. The battle zone was clear, the $75 psychological level. That's where the price fought hardest before breaking. We're seeing a flush out of long positions, the kind of move that forces traders with leverage to capitulate or get liquidated. Here's where it gets interesting. The paper price is crashing, but the Bloomberg Commodity Index announcement, that happened way back on October 30th. October 30th. So why is the panic happening now, in early January? Why did the market wait over 2 months to react to public information? The brokers say the rebalancing is the trigger, but to understand why they're lying, you need to understand the recipe. Let's pull this apart. Index rebalancing arbitrage. It sounds complicated, but it's not. Indexes like the Bloomberg Commodity Index have a recipe for their portfolio. They hold a basket of commodities in specific weights, so much energy, so much agriculture, so much precious metals. When the recipe changes, the funds that track that index must buy or sell to match the new weights. That's the rebalancing. Think of it like this. Imagine a grocery store announces they will stop carrying a specific brand of cereal next week. Even if they only have 10 boxes left on the shelf, someone starts a rumor that the cereal is toxic. Suddenly, everyone in town is throwing away their boxes today before the store even makes the change. The panic creates the price move, not the actual supply shift. That's what's happening with silver right now. The reality of the Bloomberg Commodity Index is this. Silver's weight is dropping from 4.49% to 3.94%. That's a shift of 0.55%, a tiny adjustment, a rounding error in the grand scheme of commodity markets. But the brokers are using this recipe change to create a narrative of a meltdown. They're masking their own short positions behind the index rebalancing story. Here's the pattern interrupt. Stop. Look at the chart of the last BCI rebalance. Go back and check it. Did it melt down? No, it was a non-event. A few days of minor volatility, then business as usual. So why is this time different? The difference isn't the index. The difference is the fake math they are feeding the institutions. Let me show you the numbers. This is where the lie falls apart. The conservative scenario, the truth, goes like this. Total assets under management tied to the Bloomberg Commodity Index are approximately $108 billion. Silver's weight shift, as I just said, is 0.55%. So let's do the math. 108 billion times 0.0055 equals roughly $600 million in expected selling. 600 million. That's the real number. Now, the brokers are claiming $6 billion, 78 million ounces, will be sold. That's a 10 times discrepancy, 10 times. Where is the other $5.4 billion coming from? It doesn't exist in the index. Let me stress test this for you. Let's say I'm wrong about the 108 billion figure. Let's say there are shadow funds that follow the Bloomberg Commodity Index without being officially tied to it, and the real number is double, $216 billion in total assets under management. Even then, the selling would only be $1.2 billion, still nowhere near the $6 billion meltdown narrative. But it gets better or worse, depending on how you look at it. Of that $108 billion in assets under management, only about $2.5 billion is in strict passive ETFs like DJP and BCI that must trade on the rebalance date. That represents barely 2.3% of the total assets under management. The rest is managed by professionals who already adjusted their positions back in November when the announcement was made. They've had over 2 months to execute their trades quietly without moving the market. So if the math says 600 million in realistic selling pressure, but the brokers are saying 6 billion, someone is looking for a sucker to buy their shorts. I can already hear the skeptics. But what if you're lowballing the assets under management? What about all the funds that follow the index without being officially tracked? Fair question. Let's steelman the opposing argument. Even if assets under management were triple what I estimated, $324 billion, the selling would only be $1.8 billion, still nowhere near $6 billion. And here's the thing, index rebalancing doesn't happen all at once. Professional managers have flexible execution windows. They don't just dump their entire position on the market in a single day. They use algorithms. They break up the orders. They minimize market impact because that's literally their job. The idea that 78 million ounces of silver are about to flood the market in one catastrophic wave, that's a myth. It's designed to scare retail investors into selling at the worst possible time. Let me recap where we are. We have a vertical price drop. We have a 10 times exaggeration in sell-side math, and we have a narrative being pushed by brokers who are likely at their risk limits on short positions. The trap is set. Now, how do we spot the moment it snaps shut? Here's my dashboard. I'm watching 2 primary indicators. First, open interest. If the price falls and open interest spikes, it means new shorts are piling in. That's more fuel for a potential squeeze later. If open interest falls, it's just long liquidation, the shakeout I mentioned earlier. The longs are getting flushed, but no new shorts are entering. That's actually healthier for a bottom. Second, the $77.50 line. This is the line in the sand. If we reclaim $77.50, the meltdown narrative is dead. It means the selling pressure was artificial, and the market is rejecting the broker's story. I'm also watching for institutional reaction. If the price starts to stabilize, expect news of margin hikes or more broker warnings to keep the panic alive. They need the price lower. They need your panic. Look at the volume at 75.84 right now. That isn't retail selling. Retail doesn't move volume like that. That's a coordinated dump. Institutional level pressure designed to trigger stop losses and force liquidations. I've seen this movie before. Here is how I'm playing the finale. I'm watching 3 specific triggers. I'm not guessing, I'm reacting. The aggressive trigger. If I see silver touch $74.50, followed by a long wick hammer reversal, that's a candlestick pattern where the price drops hard but closes near the highs of the period. I'm personally looking to scale into a long position. That is my signal that the liquidity hunt is over. The brokers got their flush, the weak hands are out, and now the real buyers are stepping in. I'm not going all in at once, I'm scaling. That means I'm taking small positions and adding to them as the price confirms my thesis. If I'm wrong, I lose small. If I'm right, I'm positioned for the move. The confirmation trigger. If silver reclaims $77.50, I believe the shorts are trapped. At that point, I'm looking for a squeeze back toward the low 80s. Why the low 80s? Because that's where we were trading before this dump. A return to that level would represent a full reversal of the panic move, and it would put immense pressure on anyone who shorted near these lows. The defensive trigger. If the $75 level breaks decisively on massive volume with no bounce, I'm sitting on my hands. I will not catch a falling knife while the brokers are still swinging the blade. There's no shame in waiting for confirmation. The market will tell you when it's ready to turn. You just have to be patient enough to listen. My entire approach is conditional logic. I'm waiting for the market to prove the brokers wrong before I put a dollar at risk. I'm not fighting the tape. I'm not hoping for a bounce. I'm watching the price action and the volume, and I'm letting them tell me what to do next. This is not about predicting the future. This is about responding to what the market shows you in real time. The difference between guessing and trading is evidence. I need evidence before I act. Now let me zoom out for a second and talk about why this matters beyond just the next few days. The silver market has been under pressure from short sellers for years. The paper market, futures contracts, options, ETFs, is many times larger than the physical market. That means the price of silver is determined more by financial engineering than by actual supply and demand for the metal itself. When you see moves like this, where the price drops vertically on a narrative that doesn't hold up under basic math, it's a reminder that the market is not always rational, it's not always efficient, and it's definitely not always fair. But here's the good news. These kinds of synthetic moves create opportunities. When the price is being pushed down by artificial selling pressure and the fundamentals haven't changed, that's when you can find value. That's when you can position yourself ahead of the reversal. I'm not saying silver's going to the moon tomorrow. I'm not saying this is the bottom. What I am saying is that the math doesn't support a $6 billion meltdown, and the market will eventually figure that out. When it does, the shorts are going to scramble to cover, and the price is going to move fast. The key is to be ready. The key is to have a plan. And the key is to not let fear drive your decisions. Let me also address something I've seen in the comments on previous videos. Some of you are asking, why would brokers do this? Why would they risk their reputations by spreading false information? Here's the reality. Brokers make money on volatility. They make money on volume. They make money when you trade. And if they're also positioned short, they make money when the price goes down. The narrative they're pushing isn't designed to inform you. It's designed to move you. I'm not saying this is a conspiracy. I'm saying this is how the game is played. The big players have access to better information, faster execution, and more capital than you do. They use that advantage to position themselves ahead of the moves they know are coming. And sometimes they create the moves themselves. That's why you need to think like them. You need to understand their incentives. You need to see through the narrative and look at the actual data. The Bloomberg Commodity Index rebalancing is real. The selling pressure is real. But the magnitude is wildly exaggerated. And that exaggeration is the tell. That's how you know there's more to the story. Here's another thing to consider. Physical silver supply. I've talked about this in previous videos, but it's worth repeating. The COMEX inventories have been declining. The registered silver, the silver that's actually available for delivery, is at multi-year lows. At the same time, demand for physical silver from industrial users, solar panels, electronics, and retail investors has been strong. So you have a physical market that's tight and a paper market that's being flooded with sell orders. That divergence can't last forever. Eventually, the paper price has to reconcile with the physical reality. And when it does, the move is usually violent. That's why I'm watching this so closely. That's why I have triggers in place. Because if this is the setup I think it is, the next few days could define the next few months for silver prices. Let me walk you through a hypothetical scenario. Let's say the price touches $74.50 and bounces hard. Let's say open interest drops, meaning the shorts are covering and the longs are holding. Let's say we reclaim $77.50 and start grinding higher. What happens next? The shorts who sold aggressively at 76, 75, 74 are now underwater. They're watching the price move against them. They start to panic. They start to cover. And when they cover, they have to buy. That buying pressure pushes the price higher, which forces more shorts to cover, which pushes the price even higher. That's a short squeeze. And in a market as leveraged as silver, short squeezes can be explosive. Now, let's say the opposite happens. Let's say the price breaks 75 and keeps falling. Let's say we see 73, 72, maybe even 70. What then? In that scenario, I'm stepping back. I'm waiting for stabilization. I'm looking for signs that the selling is exhausted. I'm not trying to be a hero. I'm protecting my capital so I can deploy it when the odds are in my favor. That's the difference between trading and gambling. Traders wait for setups. Gamblers hope for miracles. One more thing I want to address, the role of ETFs in all of this. A lot of retail investors hold silver through ETFs like SLV. When you own SLV, you don't own physical silver. You own shares in a trust that claims to hold physical silver. The trust is supposed to buy or sell silver to match the number of shares outstanding. But here's the catch. The trust has flexibility in when and how it executes those trades. It doesn't have to buy or sell immediately. It can use authorized participants, big banks, to manage the flows. And those authorized participants can use those flows to manipulate the price in the short term. I'm not saying SLV is a scam. I'm saying it's a tool. And like any tool, it can be used in ways that don't always benefit retail investors. If you're serious about silver, you need to understand the mechanics of how these products work. You need to know who the authorized participants are. You need to know how creation and redemption work, because that knowledge gives you an edge. All right, let's bring this home. The rebalancing math is a 10 times exaggeration. The $75 battle zone is the front line. The brokers are hunting your panic. They need you to sell so they can cover their shorts at a profit. Don't give it to them. The screen is lying. The narrative is false. The math is clear. Don't let their meltdown story become your mistake. Here's what I'm doing. I'm watching 74.50 for a reversal signal. I'm watching 77.50 for confirmation that the shorts are trapped. And I'm staying patient until the market shows me it's ready to move. I'm not predicting. I'm reacting. If you want to understand why the brokers are so desperate to push silver lower right now, go watch my previous deep dive on COMEX inventory. The physical supply situation is tighter than most people realize, and that context matters when you're trying to understand why the paper market is acting the way it is. The situation is moving fast. The next 72 hours are critical. Stay sharp. Stay focused, and don't let the noise distract you from the data. I'll be back with another update as soon as I see something worth reporting. Until then, protect your capital, trust the math, and remember, the market rewards patience and punishes panic. The brokers are counting on you to panic. Don't give them the satisfaction.